Welcome to the complex but hopeful world of today's economy. Over the course of 2023, we have seen a blend of growth, uncomfortable inflation, and changing market dynamics. The U.S. economy's GDP growing at a 4.9% annualized rate in the third quarter. This growth exceeded expectations, but was a downward revision from the previously reported 5.2% pace. Consumer spending, a key driver of economic activity, was revised to a 3.1% rate from the previously estimated 3.6% pace. Notably, the core personal consumption expenditures, PCE, an inflation measure, increased at a revised 2.0% rate in the third quarter, the smallest gain since the fourth quarter of 2020, indicating that inflation pressures might be easing. However, some indicators suggest a cooling of economic activity. The future economic conditions of the U.S. economy reveal a mixed landscape with several critical areas of concern. The Federal Reserve survey indicated a slowing in economic activity across several districts, with varying degrees of growth and challenges in sectors like manufacturing and services. Challenges persist in the U.S. labor market. 500,000 workers went on strike in 2023, demanding higher wages and improved working conditions. This comes against the backdrop of high inflation rates. There's also concern about the real pay for different types of workers, with some experiencing gains and others facing stagnation or decline, especially when adjusted for Consumer Price Index, CPI, inflation. The U.S. has seen a substantial increase in federal debt, rising from $22.7 trillion to $33.6 trillion between 2019 and 2023. The annual interest cost of the national debt is now a significant part of the federal budget, amounting to approximately $1.18 trillion, or about $9,600 per year per household, just to cover the interest. The U.S. population is aging rapidly, which is altering the country's economic activity. Older Americans, who are less likely to be worried about debt and interest rates, have been key drivers of household spending. Their spending patterns, which lean more towards healthcare, services, and leisure rather than acquiring goods, are reshaping the economy. This demographic shift will have long-term implications for various sectors. The recent inflation in the U.S., while showing signs of a downward trend, still remains above the Federal Reserve's 2% target and has profound ripple effects on the economy. Persistently high inflation rates, which peaked at 9.1% in June 2022, before falling to 3.2% in October 2023, have led to increased living costs, eroding the real value of wages and savings, particularly impacting lower and middle-income households. Higher interest rates can slow economic growth, potentially leading to reduced investment and hiring and increasing the risk of a recession. Furthermore, inflation disproportionately affects different sectors, with some industries passing on the higher costs to consumers more than others, leading to a restructuring of consumer spending patterns. The global economic situation, particularly in major economies like China, also impacts the U.S. economy. China, for example, has been experiencing deflation, which reflects weak consumer demand and problems in their property market. This affects the global economy and, by extension, the U.S. economy. The U.S. budget deficit is expected to be about 5.8% of GDP in 2023, a concern given the growing economy and low unemployment. This deficit is expected to decline slightly in the next few years, but then start to increase again. In light of these trends, investing in the current market requires a balanced approach. With the economy growing, but at a possibly slower pace, and the Federal Reserve likely to keep interest rates unchanged for the rest of the year, investors may consider a mix of growth and value stocks. The sectors that could benefit from current trends include technology, healthcare, and consumer goods, which may continue to show resilience or growth even in a slowing economy. Diversification remains a cornerstone of investment strategy, especially in a market characterized by mixed signals. Beyond stocks and bonds, people should consider broadening their portfolios to include real estate, which can offer a hedge against inflation and a source of steady income through rentals. precious metals like gold and silver, traditionally seen as safe havens during economic uncertainties, should also be a part of a diversified portfolio. It's crucial to balance these investments based on individual risk tolerance and investment horizon. The U.S. economy is navigating through a phase of resilient growth, with consumer spending being a significant driver, albeit at a moderated pace. Inflation, a key concern over the past year, shows signs of cooling, offering a breather to policymakers and investors alike, but there is no doubt there will be lasting effects that will impact prices and people's spending ability. For those looking to invest, the current market state suggests a balanced approach with a diversified portfolio. While stocks and bonds remain fundamental, expanding into real estate and precious metals could provide additional stability and growth potential. As always, it's prudent to stay informed and adapt to the evolving economic landscape. In conclusion, the economy is showing resilience, but caution is warranted as various sectors experience different growth dynamics. Investors should stay vigilant, diversify their investments, and adapt to the changing economic environment. Thanks for watching. If you found this video insightful, don't keep it to yourself. Share it with someone who could also benefit from this knowledge. Remember, understanding the economic landscape is crucial for everyone. Hit the like button to support our content, and subscribe to stay updated with more helpful information and tips on navigating financial uncertainties. Your engagement helps us grow and continue providing valuable content. Until next time, stay informed and make smart financial choices.